afternoon. Welcome to Real Estate Raw. This is Bill Ham. This is our usual session. Today's subject is going to be on market cycles. I'd like to introduce Monica Wyndham. Monica Wyndham is going to be here with us in the background. Monica is always right hand to this program. She has a tremendous amount of property management experience and asset management experience. Always likes to help out and do these programs. So jump in, tell us who you are, where you're from, and then we'll get started. All right, so today we are going to be discussing multifamily market cycles. I'm Bill Ham, and this is Real Estate Raw. Thanks for joining. So getting started, multifamily market cycles there are four portions of a full multifamily market cycle. Those are the inflation, the peak, the recession, and the trough cycle. So those are the four components of a full multifamily market cycle. The expansion, peak, recession, trough. All right, so that's our four market cycles. And the market cycles, the inflation, peak, recession, trough cycles, peak to peak or trough to trough, they're about 10 years apart, right? And so multifamily and all real estate sort of cycles up and down. What we're seeing and why multifamily cycles is based on interest rates, and why the interest rates go up and down is based on inflation. So what we're basically saying here is that multifamily market cycles are largely based on inflation and then the interest rate cycle. So that's what we see going on. Today we're talking about the four different cycles of the full multifamily market cycle, and why this is important and what we need to know about all this going forward. All right, so the reason that I teach multifamily market cycles is so that you have a full understanding of what's going on in the world, what type of debt we're supposed to get, what kind of exit strategies we like to or should be using, right? And then how do we pay attention going forward and plan certain strategies going forward. Multifamily market cycles and my information on multifamily market cycles is not really meant to teach you to time the market exactly. It's really meant to show you how to generally plan, right? And when people ask me, like, how do I know exactly where I'm at in the cycle, and how do I know how to time the markets exactly? I always say, well, you look back over your shoulder and you say, oh, there it goes, right? It's a joke. Obviously, you cannot time a market cycle, whether it's real estate, multifamily, be it stocks or anything else, right? You can never peg the market exactly. And if you try to, what you're going to wind up doing is sort of missing out on certain key aspects of the cycle and being out of cycle. So my point today is understanding the market cycle, but always staying engaged in the business and not trying to time it in and out. So it's always the right time to buy real estate. You just have to know what you're buying. You have to know what type of financing to get, and you have to know what your exit strategy is going to be. And if you line those three things up, then you're doing pretty good. So today we're going to focus on the market cycle aspect. I think right now we are at a peak or sort of peak recession part of our cycle. Again, they can be overlaid over a city, over our economy in general, right? So when we're talking market cycles right now, I'm really discussing this in a macroeconomic sense, right? Over our entire economy. You could be out of cycle, or it could be different in certain cities. Like right now, I'm saying I think we're sort of at a peak and then a recession cycle. And that's just due to values and pricing, right? And that's on the macro cycle, but in some areas we're still seeing pricing rise. We're still seeing very limited availability of assets, things of that nature. One of the big aspects of the flattening and recession cycle, and when I say recession cycle, it is just a phase of a market cycle. It does not mean the real definition of a GDP recession. So I'm not actually trying to define a real recession. I'm just using this as a term to mean the decline in supply and demand and attitude and values in multifamily. So, all right, so going into the recession cycle, one of the easiest ways you can tell we're going into a recession cycle, interest rates. That's obvious. Interest rates go up. Lending becomes a lot more difficult. So banks, traditional lenders are not as quick to lend. We're seeing all that go on right now. This is what is called the bid-ask gap between buyers and sellers. We're seeing that become huge, right? Sellers are asking way, way more than buyers are willing to offer. It's called the bid-ask gap, and that's gotten very big. All this causes the slowdown of the multifamily market cycle that ultimately goes down into the trough cycle, and that's sort of the bottom. And that's where you're going to see cap rates really start to sort of decompress over time, right? As our hold period gets longer and longer. And then after about 2 or 3 years or so, usually you're kind of out of all that, and then you're going back up in the next inflation cycle. So to kind of look back and peg this to the calendar a little bit, I would say we probably were coming out of the last sort of trough recession cycle, maybe 2011, 2012. We kind of went into '08. That was the last peak, 2008. And then we went into that kind of heavy decline after that. And I would say that lasted about 3 years, 4 years, 3 years or so. So from 2008 to 2010, 2011 or so, maybe 2012 if you were in sort of a tough market, those were sort of the trough years. And then I would say from 2012 up till just past pandemic, right, 2021 or so, 2022-ish, you were really kind of headed up. And then we've kind of been in a peak market for maybe about a year, maybe almost 2 years now, depending on who you ask and then where the rates are. Probably in that down trough cycle for a few years and then come up the other side. The reason that this is incredibly important, again, is not so that you stay out of the market and then get into the market and try and time it perfectly. It's not that. It's an understanding of what to buy, what kind of financing you want to get for these assets. So if we're at a peak cycle and we're going to go into a downward cycle, meaning the prices may decline and cap rates decompress for a little while, then you're going to want a longer term hold, right? So whereas the last 3-4 years, you've seen the BRRRR model work. Everybody's going out there buying, renovating, refinancing, pulling money out, fix and flip. That's part of the inflation cycle. As long as the tide is rising all boats, right? You can do that. As long as the valuations are constantly rising, then you get cap rate compression, and that BRRRR model of constantly refinancing and pulling all your money out works, but it works until it doesn't. It works until the interest rates go up, and then when the interest rates go up, that cycle kind of comes to an end, and that model of BRRRR becomes buying and renovating becomes a lot more difficult. And now if you're going into this recession cycle and you start trying to buy and renovate, you could literally what we call catch the falling knife, right? Happened to me back in the '08 sort of from 2007 through 2009-10. I did a handful of renovations in there, and to force the value up at the day of buying it and renovating it, only to go and refinance a few years later, and I was dead in the middle of 2011 or so, and the values had fallen back down, and that actually caused me some financial trouble. So it's understanding the market cycle, again, not trying to jump in and peg things, but understanding what you're going to be doing going forward. Length of time, are we in a market cycle where you can have a short hold period? If that's the case, then you can do fix and flips, you can do more aggressive deals, you can do things with more capex. Plumbing and things of that nature become less of an issue because the value is always going up. You get up to the top, you start to get on the other side. Now we're moving into an operator market. We're moving into a buy and hold market. You're going to be holding on to assets instead of 18 months or 2 years. Assets are now probably going to be more like 5 years, 3 to 5 years in our portfolio. And this is why I teach the conveyor belt, number one, and I say, it's 5 years long, and we got to put these assets into our business, onto our conveyor belt. And you're going to have to go out and get debt that matches that. So right now, I would say short-term loans, one, are going to be hard to get, let's be honest. But if you're going out and trying to get, 2-year bridge debt, stuff like that, that may cause you maturity exposure, which means that loan is going to come due and the market may still be off at the other side, and prices and values have not come back up. So that's where we got to be real careful about that. If you've been following me, you know that I've been talking about that for a while. That's what's occurred over the last 2 years. People came out of pandemic, bought a lot of multifamily, a lot of real estate in general, got very short-term interest-only loans, right? Then that's kind of reset. Interest rates have gone up. These loans are maturing. A lot of these lenders are having to extend and pretend. I keep talking about a lot of the loan maturities. I know I'm one of the ones talking about it, and they're there. They're just not sort of being brought to market just yet. So we're gonna have to see what that means. I think midsummer is going to be some reckoning. Another 3 months, 2-3 months. These extensions are all going to start to kind of reset again, and we'll see what that means. Foreclosures, distressed sales, I think some of all the above. We'll see. Again, that's part of that market cycle. So we're going to go into that recession cycle. Then we're going to be in the trough cycle. The recession and trough is, again, where creative financing really starts to come in. That's big. Then that's seller financing, master lease options, partnerships, different ways of doing funding and using creative financing to get deals done. Going to be big. That's why I teach a lot of the creative financing stuff. Webinar, if you missed my last webinar, it's in the chat here. You can go and get a copy of that. I did a whole presentation on creative financing using lease options, things like that. So you can go check that out. Yeah, that's market cycles. Those are your four phases. It's the expansion, sort of peak, trough, or recession, and trough. Now, what you have to understand is in that kind of up and down movement, it's not 100%. So it's not a perfect wave. It's not like you're starting at zero, going to 100, going back to zero, going to 100 to zero. It's not like that. And so when we're talking value, it's usually, let's say it rises 100, it'll level off and then come back down maybe 20, to around 80 or so, level off, and then rise up again on the other side. So it's actually more of a step type model if you were to model it out. But think about it like that. And that is why we have real estate value over time, where people say real estate always goes up in value. Yes, I agree. Real estate always goes up in value over a macro cycle, but not always over the micro cycle, right? So if we're talking 7, 10 years, 20 years, yes, I agree. Real estate values always go up. But if we're talking 2 or 3 years, be careful. The micro cycle values can really sort of jump around, whipsaw around. So when we're talking that always going up in value, that comes from the understanding of this market cycle where the values go up and level off. They do come down, but not all the way back down, just down some, level off, and then they will go back up again in the future. So if you're sitting on the sidelines, and then this is a mistake I've made in the past, you're sitting on the sidelines and you're remembering yesterday's prices and you're waiting around for the market to go back to what you remember yesterday, that is a mistake. The prices are not likely to go back to what they were yesterday, but they're also not going to stay what they are today. So you have to be looking for some discount, but don't sit here and think that these prices are going to go all the way back to where they used to be. I've missed a lot of deals and a lot of real estate market cycle thinking that, and it's a huge mistake, sitting around going, I remember back when that used to sell for blah, 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 and now I don't want to buy that property because I remember it being sold at a much, much cheaper price. Okay, that's relevant, but not always. The market changes. You always have to redo your math. Sometimes rent goes up. Things in the market change. So don't always just look back and look at yesterday's valuations. It will make you miss a good deal today or tomorrow, or it'll kind of blind you to the market changing. So those are mistakes that I have personally made in the past. Really probably just not buying enough real estate and being entirely too conservative. And again, on market cycles, that's the main thing I want everybody to understand about market cycles. Don't live and die by this. You don't really want to try and time stuff. A good deal is a good deal. A good deal is always a good deal. It doesn't matter about the market. It doesn't matter what's going on in the world. If it is a good deal, by definition, it's a good deal, right? So that's what I'm saying. Now, what is a good deal, right? Now, that might change, and what you consider to be a good deal and the debt that you can get that you might consider to make this a good deal. Yes, all of those components may change, and your criteria, even your buy right or financing criteria might change, but a good deal is always a good deal. So please stay engaged in the market. Don't, what I always tell everybody, the number one killer of success in real estate, boredom. You just wander off. You get into these markets like we have today where there's not a lot of transactions going on. People kind of get bored. They get tired of doing the underwriting. They get tired of looking at a computer screen and spreadsheets, and they just find other things to do with themselves. And then all of a sudden one day you look back and you go, oh, well, I was supposed to be looking at deals, and you've never really built a business. So pushing through boring market cycles where there's not a lot going on, that is the key to success in multifamily. That's what's going on today. I admit the market cycle is a little dry, a little boring, but they are going to come back. Deals will come back, as I always say. As buyers, we don't have mortgages. Sellers do, right? So all we have to do as buyers is sit tight and wait. And eventually, those sellers are going to have maturing loans that force them into becoming sellers, right? Motivated buyers become motivated sellers. And the world is full of a lot of motivator buyers recently, so I think we're going to see a bunch of motivated sellers going forward. Again, quick recap, 4 parts of a full market cycle. You have the expansion, peak, recession, trough, about 10 years, peak to peak, bottom to bottom. You're just kind of watching that. Different things will be going on as the markets are rising. That's when you're doing your burrs, your fix and flips. Markets leveling off as it is now, kind of declining, you're moving into a hold and operate. And that's where you're going to need people on your team that are good operators. If you're an LP, really want to be looking for strong GPs, general partners with good experience. If you're a general partner, now's the time to get educated. If you need help with property management or consulting, you can certainly reach out to Monica. She has a property management consulting firm, as well as myself. If you need help learning how to get into the business or getting started, or if you need any consulting and purchasing, call me. I have a lot of experience, and I do offer my services. You can go to realestateraw.com if you're not familiar. Check out my program right there. I also have a template, analyzer template. We'll be coming out with a fresh version of that. So if you don't have the analyzer template, you want to go check that out, the ultimate template. And that's what I have for you today. So I appreciate everybody stopping by. Market cycles, again, don't live and die by this. You can never peg the market perfectly. We're not trying to. You're just trying to understand the generality so that you don't make mistakes, macro mistakes. Pay attention to debt, pay attention to a long-term hold cycle, quality asset, location. If you get those things together, you'll be absolutely fine, and you're going to make a lot of money going forward in the real estate world. Take care.